Hello, everybody, and welcome back. Today, my guest is Robert Horrocks, Chief Investment Officer at Matthews Asia. And today, we want to discuss recent developments in Chinese financial markets. Welcome, Robert.
It's good to be back.
Robert, inflation fears of interest rate hikes and exploding commodity prices are currently dominating the markets. How did Chinese equities perform in the first half of the year?
Well, actually, Chinese equities had a pretty bad first half of the year, but it wasn't really due to inflation concerns. The core rate of inflation in China is still below 1% as we speak. So China had actually been having relatively tight monetary policy. And I think that had impacted the domestic market a little bit, along with some of the geopolitical worries and obviously the tensions around Ukraine and the longer term problems with the relationship with the US. The funny thing is, though, that just recently the Chinese market has really started to perform. And I think it does seem to be coincident with some of these inflation worries tailing off a little bit. But it's also because some of these geopolitical issues and the regulatory issues at home seem to be improving a little bit.
Hi there, just a 2-second break. Before we continue with the video, just make sure to subscribe to our channel now to not miss out any updates. Thank you very much and enjoy the video now.
Geopolitical issues is a good keyword for the next question. So the US and China have resumed talks. So how will the relationship between the world's largest and second largest economies develop during the next 12 months?
Yes, the US and China are talking again, although the relationship remains a cautious one, a suspicious one. I think the US is wary of China becoming a bigger force in the world. China, for its part, is wary of the US trying to stop it from developing its own industries and its own technology. So they'll continue to be this friction between the two countries, and that will carry on not just for the next 12 months, but I think that's going to be a permanent sort of background radiation, throughout the next decade.
Many Chinese companies listed in the US are facing a forced delisting. So will the financial markets of the two countries tend to decouple again?
It's an interesting one, isn't it, Thomas? The delisting issue, from my point of view, I don't get too concerned about it. The two sides seem to be close to an agreement, but I'm not so concerned about it because of that reason, but rather I sort of shrug my shoulders and say, okay, delist. And most of these companies already have a Hong Kong share class. So list in Hong Kong, list in the Asia market. From our point of view, we can access that. Most domestic Chinese investors can't access some of these big tech names that we know very well. And you can imagine if the Chinese investor put a price to earnings ratio on them, they might be much bigger market caps than they are even now. So I see that as something that will sort itself out in time, that is probably very beneficial for the stock prices. You just have to have patience. And I think it is emblematic, perhaps, of the fact that the Chinese stock market will dance to its own tune a little bit more. It's already got a lower correlation with the US than stock markets in Germany, for example, on average. And yes, the Asia market does seem to be a market that will be very much more focused on domestic issues, domestic companies, domestic monetary policy, and also a market, I think, that the authorities are really keen to improve the overall quality going forward. So yeah, I think there will be a certain amount of decoupling, and I think that's good for international investors.
Yeah, international investors also have withdrawn a lot of capital thanks to the Chinese friendship without limits policy towards Russia. So is this an overreaction, or do we need to reassess the political risks in China?
Well, I'm going to answer yes and yes to that. It is an overreaction, but we do need to reassess political risks. On the Ukraine invasion and China's support, that's the least concerning for me. In a way, China has shown rhetorical support, yes, but practical support much less, and is in fact adhered to all the international sanctions. I think in the US there has been a lot of overreaction, and for a time some banks pronounced China uninvestable, and they very quickly sort of changed tack on that, a lot of them, and I think they recognize themselves they've overreacted. In Europe, I think the reaction has been a lot more measured, and people have been looking at China again and saying this might be interesting, and really what is the point of their regulation? And I think here's the key issue. There was a lot of talk about China turning its back on capitalism, turning its back on private markets, taking on some of these big online companies. But what they were doing is saying that we don't want these companies to build monopolies. We don't want them to raise prices on the consumers, to lock out vendors from other platforms. So if you look at some of the second-tier online retail platforms, they've actually performed quite well because the Chinese regulations were there to create a level playing field. And then in areas like education and healthcare, it's really more about access for the lower income families into these important areas of modern life. So, yeah, I think we need to reassess. We need to understand that China believes in capitalism, but also wants a more interventionist government that will help people with lower incomes access some of these important new services. And I would just make one comment on that. I think China probably ultimately wants to look more like Europe than the US. And it currently has, if you measure income inequality through a Gini coefficient, it actually has a more equal society now than you have in the US.
At the 20th Party Congress of the Chinese Communist Party in November, so Xi Jinping wants to be confirmed in office. So what signals will be sent out by this Party Congress, and what does it mean for the Chinese financial market?
Well, the Chinese will send out the signal that we're looking after you, we're looking after your interests, that we have built a modern economy, and now we're dealing with the issues around a modern economy, some of those issues of equality that I spoke of earlier. That will be the key message. It will be very much a domestic message. They're not interested in expansionism in a military sense. I don't think they're going to spend a lot of time talking about the US and Russia and their place in the world alongside the US. It's really going to be focused on this is what the Chinese Communist Party has done for you. I do think one tricky area for them is zero COVID. You may see some signals about that, but they've said, look, we're more concerned about looking after people than we are about creating a short-term rebound in the economy. But that's one area where the messaging will be very interesting to see if there's a shift towards a slightly more liberal approach.
So you gave another great keyword. So Chinese restrictive COVID policies are stressing global supply chains. And how will this affect the Chinese stock market in the second half of 2022?
Yeah, that's a big question, I think. What happens with zero COVID? How quickly is it lifted? We see signs that the approach to lockdowns is mellowing a little bit. So I do think some of those bottlenecks will start to be removed. If you look at supply chains, the pressures are easing. Freight rates are starting to fall. Inventories at the retail side are starting to build. That suggests that there is plenty of supply coming through. I think this puts downward pressures on global prices. China still has long-term issues with its supply chains, though, and needs to diversify. You're seeing companies start to build up factories in places like Mexico, and China will follow suit by building up in Southeast Asia and in Latin America. These are the lower value-added parts of the supply chain. So I do think you'll see a gradual easing, a gradual improvement, but the issues around the supply chain are much longer lasting than just COVID.
So Didi, Alibaba, and other tech stocks have been through tough sanctions by the government. So those have cost investors billions of value. What's next for the Chinese tech sector and technology stocks?
Well, interestingly enough, the Chinese have said that most of the regulations that were coming the way of those online platforms are finished. And so they're pretty pleased with what they've done there. And I think, again, what they were trying to do is create a level platform. So yes, some of the big names have suffered. Some of the second tier names have done very well. My recommendation to investors is, if you think you're invested in a business that has monopolistic tendencies, be careful on the valuation. It'll still be a great business, but imagine the kind of returns on equity it would generate in a competitive industry and try and value it that way. So just be a little bit careful around that. But the Chinese know that technological innovation at home is going to be a big part of sustaining economic growth over the next decades. The growth that came through infrastructure spending and more capital stock was fantastic, but it's coming to an end. Now it has to be smarter use of capital. And that means better capital markets, better returns on equity. It means more innovation in the tech sector, more innovation in the healthcare sector. Two areas we're going to focus on now, we focus on now and we'll focus on in the future. But definitely you will see the Chinese encourage that. I think they will allow those companies at the very high ends of innovation to have monopolistic type profits similar to the Western patent system for some years. So I think that's a good part of the market to be invested in.
So let's talk a little bit about investments. So we have seen prices coming down in the first half of the year. So which industries and companies are you currently taking a closer look at China, and where in China do you see investment opportunities?
Yeah, it's part of it is that high innovation part of the market, because you know that the pricing controls or the regulatory controls will be a little bit more lenient there in order to spur research and development and innovation. So that's one part of it. The other part is in companies that are low-cost providers of goods and services in places like healthcare, technology, education, because they have the tailwind of providing what the Chinese government wants, that is, more access to lower-income people. And then there's the drive from China's citizens and from its government for a cleaner environment. So we look at the EV sector, for example, but perhaps more importantly, efficient use of energy monitoring systems, but all of these kinds of things that allow the economy to use its energy more efficiently and therefore cut down on pollution increases. We are focused on issues like food safety as well. And so a lot of the businesses that have high quality food supply chains, it's all about feeding into that middle class consumer. The problem of subsistence living has been solved. It's now about enjoying a better quality of life. And there are all sorts of businesses that will help support that. But they are almost entirely domestic in nature.
This was Robert Horrocks, Chief Investment Officer at Matthews Asia. Thank you very much, Robert, for being with us today and sharing your views.
Thank you. Always a pleasure.